Hello, everyone. Thank you so much for tuning into Smart Monday's investment update for June 2020. We cannot believe it's June already. Just before we kick off, I'll do a quick disclaimer around general advice warning. What that basically means is Ed and I talk a lot about the economy and investment update today. Please don't run off and make a financial decision for yourself based on that information. It doesn't take into account your personal financial circumstances. Only a financial advisor, or if you're a Smart Monday member, a smart coach can do that for you in relation to your investment options in your super. So I'm Shannon O'Shea, Head of Member and Corporate Services here at Smart Monday, joined by the wonderful Ed Tomlinson, who is Aon's Head of Investments in the Pacific region. Hi, Ed. I'll let you say hello.
Hi, everyone.
So thanks so much. So we'll kick off into this investment update. Basically, I'm here to represent the members and pose these curly questions that we're hearing from our clients and colleagues, and Ed's going to try and make some sense of them. So thanks so much, Ed. We've got a slide that we'll bring up now that is in relation to the Australian share market from the 31st of March, which was approximately the low point, up until around the 17th of June. And lots of members and clients and colleagues have noticed that investment markets have really improved since you and I last spoke, particularly Ed. I don't think the markets have improved because we last spoke, but definitely that's the timeline. At a high level, can you explain to us what this slide is and what it's trying to communicate?
Yeah, absolutely. So this chart is showing the improvement in the Australian share market since the start of the quarter, so 31st of March through to about the 17th. And what it's showing is, despite the high uncertainty around the fallout of the COVID-19 health pandemic, markets have improved. And while a rally like this isn't unusual, a rally after a big fall, the speed of this recovery has been quite extraordinary, as you can see with this chart. If you put $100 in at the start of the quarter, you're looking at about $118 at the end of this period, and that's quite a big return over such a short period of time.
Oh, that's really interesting. So since we last spoke, I recall, there's a lot of changes that have occurred, definitely around relaxing of restrictions. Victoria's just seen a little bit of those relaxations restrict itself again. But, does the world just feel like everything's getting back to normal? Is that where this bounce back has come from?
Yeah, look, that's certainly part of the good news. Reducing restrictions in Australia and also in other parts of the world have contributed. But there's also other factors. Things like the ongoing stimulus packages that governments have announced are very important. A lot of this spending is providing direct support to companies and employees, helping people get through the lockdown, but they're also providing liquidity to financial markets. And this has really helped with sentiment and helped this move that you can see. There's also other factors, and as the news comes through from the economy, and in particular, better than expected economic data from the US has really helped that share market, and it's actually moved past its all-time high point, or just about, for parts of the segments. The Australian market hasn't quite reached that point yet, but it has managed to recover almost 50% of the losses we saw earlier this year.
Yeah, it's really interesting. Ed, I think one of the questions that's coming up, especially around the news. So there's a lot of protests around the world. There was, huge unrest around Black Lives Matter, primarily in the US, and then certainly prior to that was in Hong Kong as well. So the geopolitical unrest doesn't quite match the positive market movement. Can you explain the contrast between the share market bounce back and, some of the unrest that's happening globally?
Yeah, look, I'd agree. The rise in share markets when there's unrest in the news can feel really illogical or surprising, but it really does highlight a key difference between financial markets and the real economy. And this is the financial markets look ahead. So the value of share markets reflects a potential future position for the economy, rather than just being a reflection of what's going on right now in terms of the current economic situation or the social challenges we're facing. Basically, investors are looking more at 2021 and beyond rather than what's going on right now. And we've seen some positive news come through on the health front. There's been a real flattening of the curve in many countries, although there is some increases just in the last couple of days. There's been reopening, so that's about the economy getting back on track and expectations that government stimulus should continue.
Yeah, that's really interesting that share markets kind of attempt to look forward. So when you talk about the US and then you talk about the Australian shares, I've seen again some sort of contrast in the results in the US and Australia. Can you help unravel this for us? What's the difference here in Australia?
Yeah, look, there's very, very big differences in the composition of the markets. And quite simply, the US share market has a much larger technology and healthcare sector compared to Australia. And in Australia, there's more of a financials component. And if you look at the charts that are on the screen, you can see that quite clearly. Look, to make it simple, I've just sort of pulled out the bigger sectors, but you can see quite clearly the exposure to information technology or tech is nearly a third of US shares. Now, with everything that's been going on around COVID-19, there's been increasing demand for tech and logistics and all those sorts of things, and those businesses have performed remarkably well, and the US share markets have increased as a result. So it's really no surprise that it's kept ahead. In Australia, the recovery has been more difficult. If you think about the financial sector, banks, and the challenges that they're going to face with low interest rates and potentially provisioning for bad debts, if that comes through, then you can see that there's good reasons for the Australian share market to be behind at the moment.
Okay, that makes a lot of sense. I know I've definitely read in the paper, that Australia is a bit behind in supporting tech startups, and everything's quite interlinked. It's really interesting.
Yeah.
So US share market, they're kind of leading in the technology companies, and that makes sense why they're doing well, considering we're all working from home. I'm definitely shopping online a lot more. I'm watching way too much Netflix and those sort of streaming services. What other differences are there, do you think, that would be contributing to this difference,
Yeah.
Ed?
Yeah, look, a big difference is Australian share markets focus on dividends and how this has changed as a result of the crisis. So one of the things that has happened is as companies have realized that their future is a little bit more difficult because they've had to shut down because their consumers aren't buying things, then one of the things that are done quite quickly is that you reduce your dividend to members. And this has been a real impact for our market.
Can you just break down that word dividend for us? It's one of those jargony words, just so that everyone can understand it clearly.
Yeah, okay. So all a dividend really is a payment of profits back to shareholders. And quite typically they're quarterly, they tend to be stable, although in the last couple of quarters or last quarter, we've really seen a lot of companies reduce what those expectations are. And you can see this in this chart where Australian companies on average have reduced their dividends, so payment to shareholders by so much more than other countries, really. If you compare it against US, which is on the very left-hand side, then there's a very little impact. And that has important implications for investors who rely upon dividends, perhaps pensioners or people who are relying on income to live their daily life. They're really looking for that dividend stream, and not having it there really changes the outlook on the price of shares.
Great. Thank you so much, Ed. That's definitely a lot to take in. I do want to touch on a couple of the challenges that may continue to impact. And one of the words that keeps popping up is the word recession. It's been in the media a lot lately. I think it causes a lot of worry, ultimately because not everyone knows what recession actually means and how that might impact. And I know that there's a list here of other impacts that might continue to impact the volatility in the market. Can you explain what recession is and some of these other ongoing challenges, please?
Yeah, absolutely. And it's really not surprising that people are a little bit concerned about a recession because there hasn't been one in Australia for 30 years. Look, it's basically saying that there is an ongoing decline in economic activity, and that usually comes with higher unemployment. So this is why people get a little bit concerned about it. You can see the impacts of that come through in superannuation returns. And let me just sort of talk to you about how that comes through. So if you remember earlier on, we talked about how returns and share market values are really trying to predict the future. And as we moved through the crisis, what we saw was some quite sharp decreases in superannuation returns. So this is when things were getting more difficult, but then returns recovering quite strongly. And this is about people changing their view and understanding how severe the recession looks like it would have been, and then how fast and strong the recovery could be. And share markets are really suggesting that the recovery will be pretty fast. And interestingly, fixed income markets seem to suggest that government stimulus will be needed for some time. So this is why share markets have rallied, bond yields are still very low, and returns are in a much better place than what they were. It's always really hard to say what the future impact on returns will be, despite what I've just said. There are still a few risks out there that have impact. These are on the screen. Look, COVID-19 is not over yet. Australia's in a pretty good place compared to almost all other countries, and we need to see how that unfolds. I know there's a lot of people hoping for an effective vaccine. Well, let's not get too far ahead of hope and assume that one will be there, but it could be there at some point. It's really important that there is a recovery that is sustained and supported by employment, but also confidence. It's not enough for people to continue to have their jobs or get their job back. They need to have the confidence to spend, and that's what really drives the recovery. I think we should acknowledge the upcoming US election, and it's probably fair to say that as Donald Trump and Joe Biden fight that out over the next couple of months, that there could be a lot of implications for markets, and volatility is the word I'd use. That is, prices will go up and down quite a lot. And lastly, the really, really long-term impact is that governments have spent a lot of money keeping us safe and well, and JobKeeper and those sorts of things, keeping us with a bit of money in the pocket. But you've got to pay for that at some point, and it's a long-term thing to think about. But at some point in time, the government will need to pay for what they've borrowed, and that will have implications for all sorts of things. But that's a little bit into the future from now.
Yeah, so and I'll keep you on that future track. I know you don't have a crystal ball, but linking all of these ongoing challenges and the end of the financial year, is upon us in a few days. How does this link to, superannuation and what will it mean for our balances and our returns?
Yeah, look, it's always hard to say what's going to come next, and what markets have done in the past is really no firm indication of what they're going to do in the future, and certainly not over the next 2 or 3 weeks as we come into financial year end. The good news is that only 3 months after one of the largest recessions and events that we've had in living memory, it looks possible that super returns to the end of the financial year might only show modest losses. I saw some research today from Super Ratings, and they estimated that the average Australian superannuation growth option, so this is a fund which has a rather large exposure to growth assets, could provide only a small loss to the end of the financial year. And that's quite an amazing place to be in, all considering. And certainly returns are looking so much better than what they were just a few months ago at the end of the last quarter.
Yeah, so even a small negative return, however small, could still be concerning for a lot of our members, Ed. Our Friday and Saturdays members, those that have less time between today and retirement, they'll be quite concerned around their immediate balance. Can you help explain our life cycle investment strategy and how it applies to members and their time horizon to retirement?
Absolutely, and you're so right. Even the smallest negative return is not a good place to be in. Um, this is where our life cycle strategy really helps out members, and particularly those who are moving into that retirement phase. And the chart on the screen shows how my super evolves with the member and with the member's age. So on the very left-hand side, our youngest members, our Mondays and Tuesdays, are in their 20s or a little bit younger. They have a large exposure to growth assets. So this is things like shares, property, and things that can grow really quickly, but are a little bit risky as well. And what the strategy does is reduces that exposure to growth assets and risk through time. And this does something really, really neat for older members. What it does is, for example, when there's a crisis, as we've just experienced, it means they're not that exposed to it. they're automatically de-risked. And I know that I've talked about negative returns. Those members have been really well protected. I know in a previous presentation, we talked about how the Australian share market was down 37% at one point in time. Well, those members, the older members, really didn't see any of that. And this is because they've been de-risked. They're closer to retirement, and that's the right place for someone at that age, really making sure that they can secure their retirement and have their happily ever after as they move into retirement. And this is exactly what the strategy tries to do, give the younger members the opportunity to do well and really protects those older members if things go wrong just at the last minute, which can really destroy your position in retirement.
That's great. And yeah, so they can enjoy their great weekend,
They
which is
can.
what it's all about. So, and look, again, so much insight. Thank you so much for breaking down that complexity and giving us a bit of an understanding. Otherwise, it's just really hard to grapple with all the movement in the market. So that will bring us a bit of comfort. I'll wrap up by letting all listeners know you can head to the website, you can log in, you can pick up the phone, live chat, have a chat to a smart coach if you're a Smart Monday member to apply this to your own personal circumstances within superannuation. And everyone, thanks for taking the time to invest in your financial well-being by understanding what's going on a bit more. So thanks so much again, Ed. Take care.
Thank you.